So I believe last time we had gotten through the fourth or fifth slide talking about different techniques for managing our short-term cash. And we've done some calculations around interest. Let me also pull up the camera here. We've done some calculations around interest. I want to keep practicing that today, as well as talking about different kinds of accounts and taking a look at some of that as well. So the situation, or the slide I think that we ended up on last time was talking about the fact that at this time, we've been in sort of a prolonged period of really low rates, really low interest rates. So it's not very lucrative to put your short-term cash into accounts. Just to kind of give you, I updated these slides for this year. So our average rates for Treasury notes, which is our notes that are issued by the U.S. government, are 2.67%, so that's pretty darn low. When interest rates are really low, the price of stocks or equity rises. It's an inverse relationship. So as bond and Treasury note interest rates go up, oftentimes stocks will perform on the downside, and as bond prices go down, stock prices tend to rise. So low rates, when do we like low rates? When we're doing things like buying long-term assets, like entering a mortgage. I'm locking into a mortgage for 30 years at a low rate. I'm loving that. Or a 5 or 6 year car loan. I'm loving that. What I'm not loving is this bottom one. If I'm getting towards retirement and I want to move out of stocks because they're riskier, and I want to move into something safe, the rates are really low, and it can actually even not keep up with inflation. So that can be really rough if you're trying to save for retirement. So it really does discourage savings in a way, because it's like, why even bother if I'm earning less than inflation? So it has a tendency to provoke people into higher yield investments, like moving into stocks and taking more risk. And then, I'm not going to go too much into it, but there's a couple different kinds of stocks. Well, there's lots of different kinds of stocks. But there's common stock, which is, I think, that you probably mostly think of it in the stock market. So you're buying in, you get a share of voting, you get a share of the dividends, you take a share of the risk, the upside and the downside. Preferred stock are more like bonds. You know exactly what the dividend rate's going to be. So I'm going to pay you 6% a year for a preferred stock rate on Oracle Inc., let's say, versus common stock where the interest rate can fluctuate, or the dividend rate can fluctuate, or you might not get dividends at all. So what I'm trying to say is preferred stock are almost more like bonds, where you get that fixed percentage every 6 months or every 12 months. And then again, as I was just saying earlier, when rates are so low, inflation can eat up all of your earnings, right? So if I'm earning 2.67% and inflation's 3%, every year that I save, I'm losing purchasing power. So what does that do? It loops me back in and tries to talk me into doing that second bullet up here, which is encouraging me to take maybe more risk than I'm comfortable with. So that's, can be a seriously not positive thing for folks that are nearing retirement age or risk-averse people. Okay, so again, we're talking about what we can do with short-term or liquid cash. And there's two basic broad umbrellas of financial institutions that you can put your cash in. One is called depository institutions, And depository is just what it says, and that it will actually accept ongoing cash deposits into the account. And most of these you're familiar with. Commercial banks, which would be, First Interstate Bank or Stockman's Bank or any of the banks that you see, First Security here around in Missoula. Savings and loans is pretty much what a commercial bank is. It's more of a term. Savings and loans and savings banks have a tendency to be more on the eastern coast. And then credit unions, we have a lot of credit unions here. Those are member owned. So if you're a member of a credit union, you actually have a share of ownership in the financial institution. And they pay you dividends rather than interest because you really have shares in the institution. Okay, that's a very popular model in the western part of the country. We have a lot of credit unions here. And they tend to be more lucrative. They have slightly higher interest rates. They may have slightly lower costs. And they have lots of innovative products for kids under 18 getting set up, for maybe people that have been incarcerated or chronically underemployed. They have a tendency to have a social justice component to them. And again, you have an ownership in them. So that's a model that's really popular here. I'd say probably half my tax clients have their accounts at Missoula Federal Credit Union. Oh, and the non-depository accounts is somewhere where you can park your cash, like a stock brokerage account or a mutual fund, and we're going to look at some different kinds of mutual funds where you can park cash. But it's not, its purpose is not to make deposits and write checks from them. Okay, the primary purpose is to put your cash there and earn some sort of yield on it. So, non-depository financial institutions, this is from the prior slide, we're just expanding this a little bit. Like I said, there's non-depository, two kinds of non-depository accounts, stock brokerage firms and mutual funds. A stock brokerage firm is like going with a Prudential or a D.A. Davidson or an Edward Jones or a Charles Schwab, okay? They have full access to buying and selling on the stock market. They may or may not offer a full range of their own products as well. And one of the services they provide you is a cash management account, right? So say that I open an account with D.A. Davidson and I put $10,000 in. I use that cash depository account where I put my $10,000. That's kind of my core that I use to possibly purchase stocks and bonds from or sell them, and then I sweep the cash back into my cash management account. So it's a set of tools that's at one brokerage firm. So I can get a lot of my needs met. I can buy and sell stocks and bonds and mutual funds. I can set up an IRA. I can set up an account for my kids' college. But I can also just have an account where I can have some liquid cash in it. Okay, that's a cash management account.
But you don't use like a debit card for write checks and whatever?
You don't. They may have some check writing capacity. Like a lot of them will have, like you can write 5 checks a month. But they're not to be used as a checking account.
So when you say they have liquid cash, you mean you can walk in? What do you mean?
So what I mean is that I've got access to the cash if I need it. So
like an ATM?
No, it's not like an ATM. It's if I want to use it to purchase something else within that brokerage account. Or I can write myself a check out of it if I've got like 5 checks a month, and I can say, oh, I want to pull $2,000 from it. I can write myself a check for $2,000, but it's not like I owe you $30 and I owe him $60 and I'm right. It's not like a traditional checking / debit card oriented account. But I can keep a part of it in cash if I like.
Okay.
Does that make sense?
Yeah, it just doesn't seem that liquid. That sense.
It's not as liquid as walking into Rose Hours with your debit card and paying $2 to get your cash. Absolutely not. Absolutely not. And hence they pay a little higher yield. So it's there, I can get at it, but you're right, it's not as liquid, and I'm going to get a higher yield for that, and that's why people use them. Okay, mutual funds. I don't think we've actually technically talked about a mutual fund, so I want to just spend a couple seconds here and make sure we all know what this is. So does anybody feel like they can describe what a mutual fund is? Any ideas? Vague connotation of what it is? Is it one stock?
Is it a combination of things, or?
It's a group. It's a group of some sort of like-kind security. And security is a really broad-based term for stocks, bonds, something called REITs, real estate investment trusts. What am I missing? Alfred? What's some other good examples of securities? Those are kind of the biggies.
Yeah. Usually they don't often mix bonds and stocks.
They don't right. So it's usually like, here's a mutual fund of stocks. Here's a mutual fund of bonds. But it gets way more intricate than this. It's not just stocks, it's like international. Or I just want the emerging market, which is BRIC, Brazil, Russia, India, and China. Or I just want U.S. stocks. Or I just want North American stocks. I mean, you can micro slice and dice this. And it's not just that I want international stocks, I want international stocks that deal in gold. I mean, you could just slice it and dice it very, very small. Or you can just say, I want to invest in the U.S. market. And there's a fund for each of these. It's crazy. I mean, when I first, I think, became aware of mutual funds, it was probably mid to late 80s. And there was, I remember this very definitively. I was in graduate school. I just moved back from Europe, and a friend had said to me, you should look into these mutual funds. And in grad school, I didn't have 2 nickels to rub together, but I remember very distinctly there were 500 mutual funds. And I couldn't tell you now, but I bet you there's 500,000. Any idea?
None.
Huh? I mean, lots and lots and lots and lots and lots and lots of choices. It's completely overwhelming. But each of them are a package of lots of different like-kind securities that are intended to meet your very specific goals. So what we're saying here, when you see this term all put together, money market mutual funds, that's a mutual fund that is solely comprised of money market securities, which is short-term, mid-term, long-term, CDs essentially, certificates of deposit, that allow you to get into your cash very easily and earn a slightly higher yield than just a flat-out liquid savings account. So you would invest, the kind of person that would have some money in a money market mutual fund would be somebody like myself who's getting closer to retirement. I don't want to have money sitting in a savings account for 1.2%. Because of the reason I just showed you on the last slide. I'm actually going to lose purchasing power every year. But neither do I really want that money in the stock market, because there's a lot of volatility going on in the world today. So I'm going to take a certain percentage of it and I'm going to put it in a money market mutual fund where it's not going to get me any crazy returns. I might be getting 3% a year or 3.2% a year, but at least it's keeping me even with inflation. And I have very little risk of losing any principal. So it's generally for either people that have retired, that are nearing retirement, Or like, so my husband's the CFO of the youth homes, and they have an endowment, which is something that their people that contribute to their organization give them. And he manages a pretty big chunk of money. And one of his tasks is to maximize the yield on the money that the donors have given the nonprofit without putting any of it at risk, because you don't do that in a nonprofit. So he uses a lot of different kinds of money market accounts, always trying to maximize just a little bit more yield, but without ever taking really any risk of losing the principal. Does that make sense? Okay, so I want to put a chunk of money in a depository institution, i.e. a bank, a credit union, an S&L. But I don't, I remember when all the banks went belly up in 2008? I don't want to lose my money. How does that happen? Well, we now, post-recession, 2008 recession, the amount that's insured in a depository institution went from $100,000 to $250,000. So what I'm saying is, before the recession, if I inherited a chunk of money from my grandma, say I inherited 150 grand, I put it in Lehman Brothers, name of a big brokerage firm, and they went belly up in 2008, I was only insured for the first $100,000. The other 50 grand is just poof, gone, sorry. Okay. Now that amount has gone up to $250,000. So deposit insurance protects funds on deposit. And again, that's why it's so important that you remember the difference between the depository institution and the non-depository institution, because only depository institutions are insured. So if I put my money into a money market mutual fund with Charles Schwab and they go belly up, that is not FDIC insured.
Do you pay for that insurance?
You do not pay for that insurance. It's the Federal Deposit Insurance Corporation. It's a quasi-governmental insurance agent.
So all the non-depository institutions are just all private, no affiliation at all with government, so.
No government protection. I mean, they're regulated by the SEC,
Of course.
but they're not insured. You can actually manipulate this a little bit and get all the way up to $1.5 million of coverage as partners. So I've got an account, my spouse has an account, we have a joint account, and we each have IRAs. We can be insured all the way up to $1.5 million. So, yeah, I mean, that covers combined, all together. One couple can each have individual accounts, each have an IRA, and then have a joint account is covered up to $500,000. So if you do the math on all that, you could actually, as two people, be covered up to $1.5 million together.
So is this only for like a recession or replacing something?
No, the FDIC, I can't stand by this 100%, but I believe that it came into being after the Great Depression of '29, where there had to, I mean, you've seen, I'm sure, the movies where everybody's standing in line and the bank's closed and they're just like, so sorry, out of money.
Yeah, but so if you get money taken from an account, like, I don't know if that's possible with the start of an account.
Oh, so you mean
Like, so,
like fraudulent or
Yeah, like
identity
there's a
theft?
problem on
Or
Homework where it was about like her debit card gets stolen and they take the money out. Does that cover, would this insurance cover that sort of?
No, FDIC does not cover that. That is actually private insurance that banks have to basically cover identity theft and fraud and things like that.
Okay.
Yeah, good question. Yeah, I believe that's private insurance. Okay, so checking accounts. Again, I think we ascertained the other day that most of you don't actually have checks, but you have an account that you have access via your ATM card or your debit card or checks if you do have them, and they still come under the moniker of checking account. So at credit unions, it is kind of interesting. They're called share draft accounts. So if you've got an account at Horizon Credit Union or Missoula Federal Credit Union, it's actually not called a checking account. It's called a share draft account. Again, S&L's mostly on the East Coast. Their checking accounts are called NOWs. So I do want to just take a quick practice here and run some numbers. One of the things that we are going to be doing and are going to be responsible for in this chapter is to compare different kinds of accounts and figure out which one is makes most sense for how much money you think you're going to keep in it, how many checks you're going to write a month, or what the charges are, right? So you want to be able to compare and contrast different accounts. So let's just see if we can just look at this data and figure out what we think this checking account's gonna cost us or earn us. So I want to calculate the second word there. Don't forget that we're trying to annualize this, so I want to get a number for the whole year. So the way that my bank works, or their charge system works, their fee system works, is if my balance falls below $500, they're going to charge me $6 a month. But they also pay interest if my account has a balance above $500. And when I look at my activity for the last year, I fell under $500 3 months. And over the course of the year, my average balance in my account was $1,693. So can make two calculations for me. One, you need to calculate the interest, and we know how to do that, right? Principal times rate times time. And then that's what I earned, and then compare that to what it cost me, and see if I ended up with a positive number or a negative number.
So I'm assuming the principal is the average balance there.
Yeah.
Why do you use the average, not, because you divide that by 12 to then calculate that?
I already did that. I took my balance every single month and I added it all up and divided by 12. And that's what I ended up with.
Okay.
If you were really, truly doing this like with a tremendous degree of accuracy, you would run 12
Different
calculations.
Okay, yeah.
Good question.
Because then doesn't that not necessarily count for 3 months?
So it fell under $500. I wrote a check that took me down to $100, and the next day I deposited $3,000.
Oh, so that's not the annual average balance.
This is my average balance on a monthly basis. So I really took my balance every single month and added it up and divided by 12. And on the whole, that's about what I was getting paid interest on. Okay? So you figure out two numbers for me, what they earned for interest, and then what you think they had to pay for the charges. Just happened there. Okay, so how much do you think the cost was for this account in total for the year? It fell below 3 months, right? And each month when it falls below, it's $6. So it cost him 18. Is this not? Let's see. So I think it cost him 18 in total. And then I figure the actual interest that they earned, and it's the same calculation as always, principal times rate times time, but you're only getting the interest when your balance exceeds $500. And we know that 3 of those months it went below the $500. So just the principal's the $1,693, the rate's the 1.2, and I get that for 9 of the months. So 3 of the months that I got charged, and 9 of the months I actually earned.
So is there just different kinds of accounts where they
You can do all different kinds of accounts.
or the different kinds of accounts where they make you pay a small percentage if you exceed your specific amount instead of they pay you the interest of 1% or whatever?
No, it would generally work the other way where they're going to ding you if you carry too low of a balance, because if I'm a banker and you guys all have $10,000 on deposit with me and you have $200 on deposit, you're going to generally cause me the same amount of work but generate very little income for me. So I'm going to find a way to ding you for keeping a low balance because you're not profitable to me otherwise.
I just read it wrong when I said they. I thought it was the other way around, that they had to pay because they
Oh, yeah, no.
Okay.
No, exactly opposite of what you're thinking. So this account, everybody's going to make or break a decision on $2.76. But add a couple zeros to the numbers here, and it would be a focal point.
I think when you write that though, it should be, when I read that average balance, I read that as a yearly, not for 9 months. Just from a perspective.
So yeah, let's see. I kind of agree. I think that was worded a little
Yeah,
bit.
it should be the average yearly balance, and then they give you the 1693 times 12. And then you have to divide it by 12, or they should specify that.
Let's see what this says. Okay, The account activities as follows: it's under 500 for 3 months. So what you're wanting to see is the average monthly balance equals 1693. What are you saying?
That would help.
Okay.
Well, the way it's worded says, and the average balance. Well, what are you assuming, average balance for 9 months or a year? Because
I see. So you want to know the time frame. Okay, I'll make a note of that to make sure that we look at that on the exam. Nobody probably wants to be talking about exam quite yet, but okay. So you want it specified what that average balance pertains to.
just
Yeah.
clear.
Yep. Duly noted. Savings accounts. So checking accounts are oftentimes called demand deposit, and savings accounts are referred to as time deposits. Although most savings accounts, well, it depends, but lots of savings accounts without penalty, I could put in money today and take it out tomorrow. So that's a little bit of a misnomer. It doesn't necessarily mean that I need to keep my money in for X amount of time. Although some accounts do have have penalties for early withdrawals, so you kind of have to watch out for that too. Interest is usually paid at a higher rate than on a checking account, but with rates where they're at now, not a whole ton more. Savings accounts are not particularly lucrative. I did put a link to Missoula Federal Credit Union rates. If you want to go take a look, a lot of the accounts are barely paying over 1.5%. So it's negligible. There are checking accounts that pay interest. We've talked about these. S&L call them negotiable order of withdrawal accounts. They usually require a minimum balance and they will pay some sort of interest. Money market deposit accounts. This is a bank that offers a money market account. This is not the same as a money market mutual fund. A mutual fund is this group of like-kind securities, and they are not FDIC insured, and therefore they'll pay a slightly higher rate. So for example, at Missoula Federal Credit Union, I can put my money into a money market there and get a little bit of a higher rate than just my regular savings account, and it is insured. Versus going to Edward Jones or Charles Schwab or Jack White or one of the brokerage firms and giving them my money and putting it in a money market mutual fund, then it's not insured. And the only reason why would I do that then if it wasn't insured?
Higher yield.
Yeah, I'm going to earn a little bit of a higher yield. Or I just want the ease of having everything in one place or whatever. Okay, asset management accounts. These are also basically, this is, you see these, they're called AMAs, and you see these with like a Merrill Lynch or a D.A. Davidson, the big brokerage houses where you sort of combine your investment account, your money management account, your sweep account. So I don't think we've talked about what a sweep account is. A sweep account is where cash comes through. I best explain this. So, okay, like I'll use the youth homes again. So my husband manages a couple different funds, let's say, right? One is the money that the donors give them that is restricted in something called an endowment. And that's something that the principal is going to stay there forever. And the donor's intention when they give the money to the youth homes is that their $500,000 is never spent, but the money that it earns can be used, right? That's
Get the money back.
no. So I give you $500,000, I get a big giant write-off, but I don't want you to go spend that next year. I want you to hold on to that $500,000 forever and spend the interest that's earned on it. It's very popular at universities. A lot of our faculty, high-level faculty positions are endowed. Somebody's given a gift of money and said, don't ever spend the principal, but use what the principal earns to hire a faculty member.
So is it more popular to have one specific account to have a higher rate, or would it be maybe better to have specific
Great
accounts
question.
for two different
Great
accounts?
question. And it totally depends. When you're getting into this level where you're managing an endowment or a foundation and you've got a lot of donors that you're responsible to, you will oftentimes have an investment committee that sets parameters around things like that, because he or she or whoever doesn't want to be sitting in a chair by themselves making decisions. It's like, I want you guys all on a committee and you have a bunch of parameters that say you've got to at least invest at the rate of inflation. In no situation can we be losing purchasing power. But at the same time, here's your risk parameters. I'm not interested in giving you $500,000 to run homes for kids in Western Montana and then have you go out and try and earn 20% on it and lose all the principal because it was too risky. Does that answer your question?
Yeah.
So you could have lots of different accounts for lots of different things.
Are there conditions though in endowments and even CDs where you can pull from the principal emergency condition if the roof falls off of the children's home?
Right. I would imagine there would have to be. I'm not familiar with it. It's also, this is getting a little bit into the weeds, but part of, for me, if I'm going to give you $500,000 into an endowment, there are very significant tax advantages to me. Not just like a regular charitable giving, but there's actually credits at the state level that make it very valuable to me as a donor. And I think with that comes some really stringent requirements. That money does sit there in perpetuity. So you've got this account, and then you've got, like, say, a checking account. he runs payroll through that and all of his operations, right? And then every night he sits there and it's like, there's $83,000 left in my checking account after I ran payroll today. And I get no interest in my checking account. He's got an automatic sweep set up. Any cash that's left in there goes into a money market account to earn interest for a couple days until he needs it to come back in here to run an accounts payable run. Okay.
With the account for like the foster home or whatever, could they use the interest from the principal to take out another loan, just say put a new roof on?
Oh, sure, absolutely. Unless it's restricted. I think there's lots of different kinds of funds. So I might just be like, you know what, you run United Way, I'm just going to give you $1,000 and you do whatever you want with it. Okay, that's an unrestricted, there's no parameters. Or, okay, Mackenzie is the CFO for the Humane Society. And I know they're trying to build a new shelter. So I give her $10,000, but it is restricted to being used to buy this building. Or Ruth works with Missoula Aging Services, and I give her $10,000 to put in an endowment. And she can never spend that principal. All she can do is manage the interest that it earns. So most of us, when we start giving, just give a check. And like, I don't care what you do with it, wherever you need it. But as you get more sophisticated and directed with your giving, you might want to make it more impactful in the place that needs something to you. See?
But your money in a money market mutual fund, where does that interest that you earn go? Does that go to the sweep account?
Great question. So this whole idea of a sweep account is, I shouldn't say you and I wouldn't have it. I'm mostly familiar with companies having sweep accounts because they're paying bills out of a checking account of some sort, and they don't want any excess money sitting there earning nothing. Most individual people don't have sweep accounts. They keep what they need in their checking to pay their bills, and then they've invested their money somewhere else. Does that answer your question?
How do you get, like, what you earn on a money market mutual fund?
How does it come back to you?
Yeah.
Yeah, so great question. So in any sort of a mutual fund, whether it's stocks or bonds or REITs or whatever it is, you do that because you're trying to earn some sort of return. Dividends, interest, what have you. And when you earn that, you've actually got a couple choices. Please send me that check for $3.86. Most of us don't want a check for $3.86. I want it reinvested. So buy a little bit more stock or a little bit more bonds or put it back into my money market mutual account. So it's reinvested.
So do you ever use the money or?
You can if you pull it out, but it's kind of back to what we were looking at last week where you like that idea of compounded interest on compounded interest. So if I take that $3.86 and put it in my account, then next month when they calculate interest, they calculate interest on interest. And that's, again, that power of time and compounding. But you can take it.
Does the donor have tax credits every year, or does it only occur the year that they...
Really good questions. You guys have asked the best questions of any class I've ever taught this to. So there's lots of different ways to get tax benefits. For most of us, if we write a check to a nonprofit, we are going to get a tax deduction. You know these words. If we itemize our deductions rather than standard, we're going to get a tax benefit in the amount of whatever the check was we wrote times our highest marginal tax bracket. So I write a check for $5,000 to the Humane Society. I'm in the 20% bracket. I itemize my deductions. I just saved $1,000 in taxes. So it really only cost me $4,000 to give $5,000. Does that make sense? Because I got a tax break. When you get into things like endowments and charitable trusts and other sorts of tools at end-of-life giving, right? So I'm getting older, my kids are doing fine, I've saved well. I'm not going to be able to spend all the money I've saved. And I don't necessarily need to leave my kids very much. I'm going to start thinking about, what do I want to do with this money? I want to do some charitable giving. And then you can get into these lifetime trusts, and the tax ramifications get significantly more beneficial.
Each year.
Mm-hmm.
And that would be like an endowment.
So the endowment isn't the name of the tax benefit. The endowment is the name of the tool that the money goes into. There's whole, so you're interested in the nonprofit aspect of this. There's whole like classes around both if you're the nonprofit trying to get money in. How do I'm going to look to you to give me money in a very different way than I am you. I want you to write a check for $5 a month. I want him to sign over half of his estate as he gets diagnosed with Alzheimer's. I mean, truthfully, and I want you to buy the new building and put your name on it. I mean, you have different relationships with different kinds of donors, and there's different tax carrots for each kind of donor.
For both the receiver and the giver.
Yep. It's a pretty complex area, and there's like big organizations like United Way and the youth homes and Humane Society and like big organizations. They have people that do nothing but that. I mean, they know they can sell this depending upon your situation.
Are they considered nonprofit if they continuously use the sweep method and build interest on interest?
So to consider yourself a nonprofit, you have to have applied to the IRS for nonprofit status. And there's a number of different kinds. But really, you can't call yourself a nonprofit unless you've gone through this really hairy application form and convinced the IRS that you shouldn't have to pay taxes. That's what makes you a nonprofit.
Okay.
And then you can do things that are profitable as part of a nonprofit if your overall arching goal isn't to make a profit. In other words, I'm the Humane Society, my overall arching goal is to take care of animals. But obviously, I've got to generate money to do that.
On the major money management companies like Fidelity and all those others,
Yeah.
isn't it part of their course of operation that you are invested with them, that any dividends are actually just automatically reinvested in stock? Because I've never really seen an option for pulling off dividends in mutual funds.
Right, yeah, so good point. That kind of ties in, Sadie, with what you were asking, like what happens to my money market earnings? What happens to my dividends? And Alfred's saying that he's not ever seen the option where you could actually get that check for $4.86 yourself. And that's true, most of them will just default to reinvestment. But if you wanted to pull that, you could. But by default, of course, they want to keep your money, they want to keep it reinvested.
Yeah.
Great. Okay. This is barely even worth talking about. You guys know what debit cards are, you know what ATMs are, and you know that if you want to, you can set up pre-authorized deposits or payments. I want my check to go straight into my bank account, and once a month I want them to zap it for my gym fees or my car insurance, right? So pretty straightforward. Okay, we talked about the importance of a regular bank reconciliation. We practiced this last time. We're going to go over our bank rec that we started last time today as we go over our homework. I know that, and again, that many of you or most of you don't actually write checks and get a paper bank statement, but I still believe that it's very important on a monthly basis, particularly as your lives get more complex financially. And maybe you've got a couple people on the account, and you've got lots of different prepaid monthly things coming in or out. It is really, really, really important on a monthly basis to reconcile that account. And then one thing I do want to talk about here that's really worth a think is this third bullet, major bullet called overdraft protection. And it's a short term, you have to apply for it with your bank, and it's a short term, finite, small credit line essentially. So I say to my bank, if I overdraw, like, I don't have my ducks in a row and I'm not reconciling and oh my gosh, I accidentally overdrew my checking account, instead of hitting me $35 or $45 every check or every zap of the ATM, right? I want you to lend me up to $500 to cover that overdraft. And then they just do that. They just cover my overdraft, and then I have to pay them interest on the amount that they've lent me. And I can tell you that's come in handy for me many times over the years, where I'd like to tell you that I always know exactly what's going on in my account, and sometimes I don't. And sometimes when you share your account with somebody else, they might not tell you. So all of a sudden it's like, oh my gosh, I've got a couple overdrafts. You go in, they just pull money off the short-term credit line and put it into your checking account. And then they charge you a daily interest rate because they've lent you money.
Is credit line not the word for loan?
And, okay, good question. The difference between a credit line and a loan. Anybody have a feel for that?
Is that like a maximum?
A line is like, you know what, I'll cover you up to 10 grand. But if you only need 300, that's all I give you. But I'll cover you up to 10 grand. So you take 300 tomorrow and 5 grand tomorrow, and it's calculated on how much you borrow. But if you take a loan for $10,000, I just write you a check for 10 grand. So, go ahead.
So the difference between like a monthly loan, let's say,
Yeah.
and like a long-term loan,
Mhm.
let's say they loan you like $10,000.
Right.
But you only need a specific amount of it.
Right.
You still have to pay that interest of $10,000 compared to the interest
Exactly, which is why you wouldn't want a loan in that situation.
Yeah.
You would want a line.
Okay.
Like so traditionally lines, credit lines are for businesses, for working capital for businesses. So I go to my banker and I sell snowmobiles. It's a very cyclical business. I do all my business in 4 months, but in the middle of the summer when I've got no sales, I have to go buy my inventory for next season. So I have an enormous cash outlay when I have no cash coming in. I go to my banker, I'm like, I need a $200,000 line of credit. Because when I show up, I don't know where they buy their snowmobiles. Let's say they go down to Denver or Salt Lake or something, they do all their buying, they've got to write a big ass check. And 1 year I might need 172,000, and the next 93, and the third year I might max it out. I don't want to pay interest on the full 200,000 if I only need 73.
Well, how come it's a little different with the overdraft that you're talking about, or like a credit card every month?
No, so overdraft is exactly what I'm talking about. Is exactly similar to that.
So you still have to pay interest on the 500, even if you only need 100.
No, I only have to pay interest on what I actually take,
Okay.
which is similar to the inventory loan I was just talking about. So I come to you and I'm like, can you cover me for 200 grand? I'm going out to do my buying. And you take my financial statements and you run a credit check and you look at my tax return for the last 3 years and you go, yep, 200 grand credit line. And I go down there and it's like, for whatever reason, I get some big volume discount or I'm not impressed with the inventory. And I come back and I'm like, I've only written a check for $72,000 to my vendors. That's all I'm going to pay interest on. And that's the same with the credit overdraft with one of these guys. Yeah. Versus a loan is like, I don't want to take a $200,000 loan in the situation I just gave you because why would I pay interest on all that if I don't need it? Right? That's a very important differentiation and a really important cash management tool. We'll talk about it in one of the next chapters. As you start to pay down the mortgage in your home, you have equity in your home. In other words, you own a chunk of it, and you can borrow a home equity line against that if you need some of that money. Oh, it's time to send my kid to college. I don't want to go pay 10% to a banker. I want to borrow from my own self out of the equity in my home, right? But I only take out enough to write the tuition check every fall and every spring. I'm not going to take out what I think it's going to cost you for 4 years. So I'm only paying interest as I go. Does that make sense?
Most home equity line of credits will not do that. In Texas, well, they don't make you do it and then charge you a fee.
No, the ones I'm familiar with, you do a credit check and you write a line,
Yeah.
and then I can pull $500 next month and then pay it down the next month, and then pull $5,000 the third month and pay it down $100 the next month. And I strongly believe that as you get more equity in your home, that you should always have ability to get into that maximum line if you need to, because when you really need money, you can't get it because there's a reason you really need it. So if you've got ownership of $100,000 in your own house, why would you not have access to that?
If you take money from that 100,000 though, then you have to take longer to pay off the mortgage.
It's a separate note.
Okay.
It's a separate note. You always have your main mortgage, and that's called a first. So if I said to you, hey, how much is your first mortgage? You would tell me $150,000. That means that's how much you owe on your primary mortgage. And then if I said, do you have a second? That means do you have a second loan on your home? A home equity line. But one thing you have to pay attention with that is both parties, both the first and the second, either of them have a right to come take your home if you miss a payment. So, with all that said, home equity lines are really sweet, low interest rate deals, but your house is on the line.
If you repetitively change your home equity though, even if you make all your payments, could that still penalize you in more interest? Or
Say that again?
like if you have more than, if you have to repetitively change your equity, but you still make all your payments, is there still any like penalty and interest or?
Change my equity, you mean pay down my mortgage?
Yeah, but it's just going up and down repetitively and it's just kind of, it's
Oh,
not really.
no, usually the home equity lines I'm familiar with, well, it depends on the institution, but normally you have to rewrite them every either 5, 10, or 15 years. So you get X, and then you go down the road 10 years, and obviously you paid your house way down, so when you go to rewrite that home equity line, you can get more of that next time. But you guys, with that said, I've also seen some real horror stories about people that borrow equity on their homes to go to Maui and buy a Mercedes and do all sorts of things that they have no business doing on their income level. And then it's like one person loses their job and it's like, shit, I can't make a $300 a month home equity line payment and I lose my house. And I can't even find Maui on a map anymore. So it's not, I'm not saying everybody go get a home equity line someday because they can be very dangerous. And then we've talked about this, like how do I get started savings? And I've said this over and over, not to beat a dead horse, but I just believe so strongly that even if you're low income or minimal income or struggling student, whatever, to get in the habit of just saying once a paycheck or once a month, I want you to take $10, $12, $15, I don't care what it is, and move it out of my checking account and into some sort of time deposit account, some sort of savings account. And as you get further down the road, I'm a big believer in having more than one kind of savings account. We've talked about that, like those big expenses you have once a year. MFCU, I've got something like 7 savings accounts with little names on them. Travel savings, tax savings, Christmas savings, life insurance savings, and just have amounts moved in every month to each of those. So if I wanted to take a trip, it's not like, oh my gosh, where would I ever get the money to do that? I've put away $50 a month, right? Continue to transfer funds on an ongoing basis. The second bullet, we've talked about this. Any financial planner is going to tell you before you do anything, you should have 6 to 9 months of out-of-pocket living expenses in an account. I mean, I will tell you, I've been at this a lot of years. 9 months of living expenses just sitting in cash. It's never happened in my life. It's supposed to. That's where you're supposed to get. But, depending upon what your monthly budget looks like, that can be, kind of a lot of money. But definitely at least establish what you feel safe with. And I know a lot of you are still dependent on parents and loans and so forth, but if something happened tomorrow, say fast forward 5 years and say you're still single, if something, I'm making $30,000 a year, and if something happened tomorrow and I lost my job, How many months do you feel like you need in a bank account to feel comfortable to get back on your feet? You know, for most of us, that answer is at least 3 months, right? Financial planners tell you 6 to 9, but establish what you feel comfortable with and head towards that goal. Okay, let's just practice one more set of interests, and then I want to take a look at the homework. So if you want to get out your calculators again, we're just going to go through this one more time, and I'm going to make a final contrast on the difference between simple interest and compound interest. And I think that you know what this is, but I just want to illustrate it from a quantitative perspective. So we know that simple interest is you deposit X and then I just pay you a percentage based on that original investment. Whereas compound interest is you earn interest on it and then you have a new principal. And you earn interest on that. Then you have yet another new principal. And so in perpetuity, the interest grows. So let's just start and take the first one. I invested $10,000 at 5%. You should probably practically be able to do this in your head. How much do I have in 1 year? So actually write it out, principal times rate times time. And then I want you to try the second one where I earn 5% semi-annually. I want you to tell me how much I'm going to have in a year if my interest compounds semi-annually. And then we're going to compare the two numbers.
Oh no, I'm just.
Okay. So which one did you end up having more money at the end of the year? First one or second one? Second one, obviously. Because my interest got posted every 6 months. Right? So let's take a look at the math on it. In the first situation, pretty straightforward. Principal times rate times time. Right? 5% posted once a year. My time is 12/12. And remember, even when it's a year, I always want you to write out this fraction and make your denominator 12, and then the numerator is how many months are we talking? So in the second example, it's that same calculation, 10,000 times 0.05, but what's my T? How much is my T? 6/12. So after 6 months, I have $10,250, right? So my second calculation, my principal is now 10,250 times 0.05 times 6/12. So at the end, I've obviously made $57.50 more because the interest got posted every 6 months. What would you anticipate happens if I gave you the same problem and said the interest compounds quarterly? It's going to be even higher, right? Interest compounds monthly, higher again. So what I'm trying to illustrate is as we get more sophisticated in looking at yield, it's not just 5% versus 6%. Clearly I'm going to go with 6%. The other question you have to ask is, what's the compounding schedule? Because you can be given a lower APR that compounds more frequently, that's going to yield you a whole bunch more than a higher APR that only compounds once a year. Does that make sense?
I keep getting 256 for the 75
$10,250 times 0.05 times 6/12. Do you? Okay, well maybe I screwed up. Certainly a possibility.
Still more.
Just not as much. 10,250 times 0.05. Yeah. Oh, sorry. I don't know where that came from. Thanks, Sadie. So, 256.25. So what's that?
506.
Huh, okay, great. So then the next question is, what is the effective interest rate? In other words, I want you to now tell me in the second situation, what was the APR? And it's how much interest was earned divided by the base principal that I put in. How much interest did I earn all year divided by my original principal?
For the compound one?
Yep. And where I'm going with all this is now you can really compare these two, can't you? Up here I earned 5%, down here I earned 5.0625%. Clearly, the second option is better.
If you do a compound interest, like savings account for instance, do they normally give you an APR, or do they just basically make you do the math?
No, they have to give you an APR. Our consumer protection laws require that everything that we do in this country, whether it's borrowing money or taking out a credit card or anything, has to be quoted as an APR.
Instead of just saying 5% semi-annually or something like that.
Yep.
And so this is only in the first year. Would the effective rate go up year by year?
So in the second year, if I'm starting in, with the 10,506.25, my effective rate's going to go up because my interest is being calculated and compounded on a bigger number.
And your nominal will stay the same.
Yep. So that's the power of compounding. That's what all those future value tables were about.
Why would you ever do not compound?
Because that's not
You don't have
offered.
a choice.
They don't have a, yeah, you don't have a choice. And, yeah, so, but that's my point, is cases that it helps you say like, oh, here's a 4% compounded quarterly option, or a 5% compounded annually. A lot of people just see that 5% and go for it, without understanding this.
But if you were really old, maybe you want to do
I don't know that age is going to have anything to do with this. I think I'd always want the interest posted to my account more often. All right, I am going to ask that you do these last 4 slides on your own. So let me just put this up somewhere. So in fact, let me just kind of do that all together right now. So for Wednesday, there's more math on those last 4 slides. I want to spend some time on the homework today. So finish, I think it was 19 through 21, right, for chapter 4. I want you to do number 8 and 9 for, what page am I on here? That's chapter 3. Numbers 8 and 9 from the end of chapter 4. Page 159 is due. And then for chapter 6, I want you just to do a little reading intro. So we're skipping 5. And I want you to read, oops, that's not helpful, is it? Oh, there we go. Read C6 through page 238, and I'm going to start, we'll go through the homework when we come into class on Wednesday, and then we'll pile into chapter 6. So for today, I asked you to do 3, 4, 5, and 6. Let me go find that. So number 3, we're on page 158. I will put the points up here after we're done.
19 through 20.
Sorry?
Oh, you just asked me about homework.
Oh, let's see. Right here. Everyone get that? All right. And today we're going over 3, 4, 5, and 6 from page 158. Yeah? Okay. So, the first question on number 3 was you got your ATM stolen. And Casey was asking about this earlier. Is that the FDIC insured situation? That is not. The banks are contract with private insurers for liability backfill on these kinds of things. I can't even begin to estimate. I mean, it's got to be in the billions of dollars annually that are, I mean, I know scads of people who've had their identity stolen and their ATM cards utilized. You don't hear about it so much up here, but I've got family in Austin and Vegas and bigger cities, and it's just kind of standard fare. So yeah, somebody's paying for that for sure. So someone steals your ATM. They withdraw $950 from your checking account. How much money could you lose according to federal legislation if you reported the stolen card to the bank day of, you reported the stolen card to the bank 6 days after the theft, or you waited 65 days? Harrison, what happens if you report same day?
So that's what I was wondering, because if it was, I think I got confused between that and where you have the $250,000 in insurance.
Okay, so let me just make that clear again. The FDIC, the Federal Deposit Insurance Corporation, FDIC, they insure your demand accounts. In other words, your checking accounts. For an amount, if the bank defaults, if the bank becomes illiquid, if the bank becomes insolvent, that FDIC insurance is not from day-to-day operational theft or identity fraud or anything like that. That's if the bank becomes insolvent. Okay, what did you find, Evan?
I got, it was $50.
$50, that's what you're liable for. Okay, day of. What happens, Mackenzie, if you wait for 6 days? I think that amount is $500. Is that what this says? Zoom. $500, and I think that's if you notify within a week, correct? That's your maximum liability.
Or the amount.
Or the amount. Certainly, if I've only got $26 in my checking account and they steal my card and, bankrupt me, I'm not liable for $500, I'm liable for 26.
With the overdraft.
Good question. So if you overdraft and you've got that overdraft line, I bet you that goes into the balance too that you're liable for. Sure you would be. Anybody here ever gotten their stuff stolen? I had somebody walk into my office at the old building and take my wallet right out of my purse sitting in my office on the Friday of finals week right before Christmas break, probably 12, 13 years ago. And it's a Friday night, I come home, I had little kids at home, they weren't going anywhere. I don't even think I looked in my purse until Sunday. I didn't have any reason to. And it was like, oh, wow, my whole wallet's gone. But I called, reported it, and they had charged like $3,900 worth of stuff at the mall. And they had been in 21 different shops. And I have right on my card, both of my cards, ID required. 21 shops, and not a single person is like, can I see your ID?
Who's liable for that?
The bank was. The 22nd shop was the Buckle. It was a young woman. It was like, can I see your ID, Lisa? And then I guess the gal got really flustered, and then she said, well, what's your middle initial? And she didn't know that, and then she just turned and bolted out of the mall. And they had quite a field day. So, note to self, lock your office.
So you only lost 50 though?
One more time.
You only lost 50?
I lost a couple $100 because it was whatever, the amount wasn't 500 back then, because I did not report a day of, I did not report a day after, I reported it like third day after.
But isn't it after 6 days that, or?
Day of, and the numbers were different back then too, but day of is 50, and then up to a week is now 500, and back then I think up to a week was like $300 or $350. It was kind of a lot of money for me at the time.
Yeah.
But it wasn't $3,800. Okay, and then the next one says you're getting married, you're unhappy with your current bank, what are you looking for? Really, the 3 things that you should have. Okay, I'm sorry. So for that first one, there's a possibility of 3 points. So tell me how, for 1 point each for A, B, and C. So tell me how many you got right out of that, plus whatever, plus 1, plus 2, or plus 3. And then for number 4, you had to have some combination. It doesn't have to be these exact words, but if you're looking with a partner for a place to have an account, to share an account, you've got to look at what we just looked at, the costs, right, the net costs. So some sort of earnings/fee analysis that gets you to that net number, like we're going to make X a year or we're going to pay X a year, right? And then I want to know what they do for me. Do I get a free debit card? Do I get overdraft insurance? Things like that. So some sort of services. And then, for most of us anymore, do you think people still choose their bank based on location? When's the last time you've been to your bank? Do you go? Oh, so you would still choose it, that's interesting to me for a younger dynamic, I would think you did everything digitally. You still actually go to your bank, so convenience is a factor. All right, 2 points on this one, if you've got 2 of the 3. So something about costs or earnings, something about what kinds of services or products they provide you, and or something about convenience. If you got 2 of the 3 of those, give yourself +2. And then number 5 was what we just practiced. I want the annual cost of this checking account. They charge me $4 a month just to have it. And then they charge me 20 cents to process each check. And I write 23 checks a month. This is obviously some sort of commercial account. Right, I've got some sort of business. And then they give me my annual interest rate is 2.5% if my balance exceeds, oh no, these are 2 different ones? Or is this all one account? This is all one account. And then secondly, I get interest if balance exceeds $750, but I have to pay $8 if it falls below that, and my average monthly balance is $815. So I'm going to get interest for 8 months, and I'm going to get charged for 4. So here's my total cost, right? So that looks like, what is that, $111.80? Is that right? No, is this the right one? I'm confused. What happened to the $4? Oh, that's up here. Okay. So, I'm sorry. So this is part A, right? I pay $4 a month to have my my checks processed, and then 20 cents a check. So on the monthly average, it's $8.60, and then of course there's 12 months. So the $103.20 goes with part A.
Why wouldn't it be 4 times 12? Because you pay.
Well, it is in there. The 4 times 12 is in there. So I get the monthly cost, and then I multiply it by 12. But you could have done 4 times 12 plus 23 times 20 cents times 12.
You need 4
Huh?
plus parentheses 23 times 22.
Yeah.
You have the parentheses on one side. That would be 4 plus 23 would be 27 times.
Yeah, there should be parentheses around the 23. I agree. I agree. And then in the second part of it, I'm getting interest. So, and this isn't how you're used to seeing this. Sorry, let me put this how you're used to seeing it. So my principal is $815, and my rate is how much is my rate? 2.5. And how many months do I get my interest for? 8/12. So that's down here. So I earn $13.60 a year in interest, and 8 of the months I had to pay. I'm sorry, 4 of the months I had to pay. And therefore, it cost me $18.40 because I earned less interest than it cost me. So if you got the $103.20 for part A, give yourself +1.
I think I might put a little hair there on that. I put this with 18.2. Has to be a little hair there.
Okay, that's fine. You're close. and actually you should normally write your work on the actual homework so you can see what you did.
Okay.
And then for the second one, for part B, let's break that into two parts. So if you got that they earned $13.60, give yourself +1. And if you got that it cost them $32, give yourself +1. So that's 3 points. And so number 3 had 3 points, right? Or 2? 3. And number 4 had 2. And number 5 has 3. So I'm going to take a look at your bank reconciliations because we're out of time. So if you could just tell me on the top how many you got out of 8 and circle it and make sure your name's on it, I would appreciate it. And you can pass those over. You know what you've got for tomorrow.
Shouldn't 5 be 4 points because A was a separate point?
I'm sorry?
Wasn't A 1 point?
Yeah, I think I gave you 1 point for A and 2 points for B. Yeah, so in part B, you got 1 point if you got the amount earned of $13.60, and in part B, you got 1 point if you got the cost of $32, and then I assume you could net those two numbers. Okay, and then just pass them down this way. Tell me how many you got out of 8 points, please. And make sure that, we don't have a staple, but make sure that your bank reconciliation is on the back of numbers 3, 4, and 5, because I'm going to take a look at that.
So the one that we did in class, started in class.
That's number 6. It was due as part of the homework today.
So we're turning that in.
You're turning that in. That was part of the homework for today. Yeah.
Staple?
I don't know that we have a stapler. Do we? Oh, perfect. Yeah, if you've got a stapler, staple it, please.